All right, well, welcome to the latest Barside Chat for Maslow Wealth Advisory. I'd like to welcome back our portfolio manager and my colleague, Isaac Thompson. How are you doing today?
Doing great.
Great, and as many of you know, my name is Matt Jakimiak, and I am partner as well as CIO for the firm. But we're here to just talk about markets, and there's a lot going on, so why don't we just jump right in? So from a macro perspective, a lot of things going on, and everything from Trump tariffs to government spending and their potential impact on inflation, interest rates, and the broader economy. We're not going to tackle those directly. As many of you know, we don't really talk about the markets and how we're going to trade around those because that's not what we do. We build durable portfolios that withstand through any kind of market cycle. But what we have been spending a lot of time on the investment committee side is kind of our global allocation on the equity side and how that is ultimately being influenced by the market today. And so, Isaac, what I thought I would ask you today is, like, what are we talking about? Why are we talking about it? And are there any changes coming relative to our equity exposure, not only here in the US, but developed international as well as emerging markets?
Yeah, absolutely. It's a great question. And I think the reason we're talking about it is the US concentration of global equity market cap is at an all-time high. It's over 65%. And it's really gotten there as the last couple of years, the US market has just been on a tear. It's been up over 20% the last 2 years. It's more than doubled off its COVID lows. The Mag 7 has driven a lot of this growth. Mag 7's cumulative market cap is larger than any non-US country. And so we're seeing just a lot of concentration in US-based stocks and equity markets. But if we kind of zoom out a little bit, the last 3 years rolling average is only 60%. If we zoom out to 5 years, the rolling average is under 60%, and the 10-year average of US concentration of global equity market cap is only 55%. So clearly we've seen a pretty significant run up. But when we look at this, we tend to want to take kind of a longer view rather than kind of chasing performance. I think it's important to note that market cap is fundamentally a function of price. All else equal, if a stock price doubles, its market cap will double. So what we don't want to be doing is chasing and buying assets after they have gotten very expensive. When we look at the US concentration, I think we probably expect a little bit of mean reversion. It's possible that it ends up finding an equilibrium at a higher point than it historically has been, but I think that's something that we'll continue to keep our eye on going forward.
Great. That's it. I know it's a big question that we've been tackling, and I don't know how we ultimately will shake out or get to those answers, but it's something that we explore virtually every time we meet.
All right, well, enough about geographic diversification and selection. What about diversifying across the capital stack? How are you thinking about equity versus debt?
It's a great question, and I'll try and boil it down as simply as I can. It almost kind of brings me back to Finance 101 back when I was at University of Texas getting my MBA. If we think about a company in general, essentially a company has the ability to generate a finite amount of return or income on an annual basis, right? And that return ultimately will be split between the fixed income and the equity owners of the business, right? That's all we can do. And so, again, we made some simplifying assumptions that like multiples aren't going to change and those sorts of things. But let's just say in a perfect world, the company earns $100 of earnings. That $100 has to be split between the fixed income holders and then the equity holders. And in that preference, we know fixed income gets its return first because its return is fixed. And then anything in excess will go to the equity holders. And I promise me, we're going to get to the question that you asked. But I think that's the framework that we need to start with, right? And so when we think about it, all right, so if we are a fixed income holder or we're buyers of credit or spread product, the things that we're thinking about are, A, is the money safe, right? So are there going to be any defaults? Secondly, what are we being compensated for the risk that we're taking? And so that is that spread, right? And so when we talk about spread, it's spread relative to US Treasuries. So if it is a company that has a high probability of default, our spread should be a lot higher than something that is like AAA, like US governments. Spread to treasuries is zero because it is the treasury. Now, what we have seen over the last, call it 10 years or so, is that spread has come in on our fixed income product, but we've also seen that defaults are trending at very low rates. Historically, they've been over around 3.5%, almost 4%. We're coming in over the last 10 years somewhere around 2.5%, less than 3%. And even recoveries on defaulted fixed income is much higher than what we would anticipate. So that's exciting, okay? Now we flip the page and we say, all right, well, what about on the equity side? Well, on the equity side, again, it is the stub of all earnings, right? So fixed income will get paid first. Anything that's left is equities. So when things are really exciting, the economy's growing and valuations on equities are cheap, like it's an exciting time to be invested in equities because there's a lot of potential for explosive growth in terms of what our equity can do. Well, I think we're at the tail end of that. From my perspective, again, we're not macro forecasters, but if we look at valuations on equities, like the S&P 500 right now is trading at around 22.5 times earnings. That's forward earnings. That's not expensive, but it's clearly not cheap. Historically, it's somewhere in the high teens, okay? If we look at another measure, which is a little bit more normalized, if we look at the Shiller CAPE index or ratio, that actually is trading at, look at my numbers here, 34 times. So what that essentially does is it annualizes and it basically takes a 10-year average of normalized earnings and says, what is essentially the PE ratio of the S&P 500? 34 times. That is really expensive, okay? So what that tells me is like stocks aren't cheap. Now, if we put that, if we kind of summarize everything and we put it into the framework of something that's macro, we just talked about like there's a lot of macro things going on from, tariffs to the economy just slowing, government pulling back on its spending through Doge and other things. All right, so there are going to be headwinds for companies to make earnings. We know equities are expensive. Fixed income still has a generous spread relative to treasuries, and it's the first in line to get paid. If I look at that, like fixed income's almost kind of like in this Goldilocks scenario. And then we also throw in kind of this other thing, which is like the Fed, right? The Fed, when it comes in and rescues markets, it doesn't necessarily rescue equity markets. Like I've never seen the Fed prospectively come out and say, we're cutting interest rates because we want to save the equity market. We're cutting rates typically because we want to save the fixed income market, right? They want to make credit cheaper for people. So ultimately, there's kind of this implied put or mechanism to help fixed income and credit as opposed to equities. So I look at this and I say, maybe our credit and private credit are in this Goldilocks environment where we're getting a decent amount of spread for the risk that we're taking. It has low default risk, and even on defaults, we're having higher recapture of whatever that default is. So I look at this and kind of the trade-offs are aligning with something that would suggest that we want to be more fixed income oriented and more specifically probably on the private or direct lending side where those managers can control somewhat the outcomes that they're getting as opposed to something that is on the public side where they're really at the whim of any trade that ultimately happens. So this probably dovetails well with some of the things that we're doing in portfolios today and hope to do for the next couple years in portfolios with private lending and direct lending and potentially setting up our own fund. But that's the way I'm thinking about it today.
Got it. Yeah, makes a lot of sense.
Awesome.
Well, that does it for another Barside Chat. On behalf of myself and our CIO, Matt Jakimiak, thanks for stopping by.